Hello, welcome back to another video on recession trading. As we are anticipating a recession in 2024, let's take a look at comparing returns on some sectors and perhaps plan ahead to take advantage of the returns as we go into a recession and come out of a recession. All right, on the chart here, we have time frame, as you can see, January 2008 through December 2010, 3 years. This yellow line right here, vertical line, is when the Fed start to cut rate, all right, in September of 2008. And you see three lines on the chart. You have the candlestick, red and green, that the XLP, that's the consumer staples. And then you have the purple line, which is the S&P 500. And lastly, the blue line is the consumer discretionary. So for this video, specifically, I want to focus on consumer staples versus consumer discretionary, two opposite ends of the way consumers spend into a recession and coming out of a recession. No doubt you can see it makes sense how the consumer discretionary match the S&P 500 on the way down. As layoff mount and fear mount, guess what? People spend less on Starbucks, travel less, eating out less, all of that, okay? I do disagree with some of the component of the XLY because McDonald's in there. If anything, you should not be fearful of McDonald's or avoid investing in McDonald's going into a recession, because if people are going to go out to eat or cut back, they will cut back on many things. They're more likely to go to McDonald's more. And the chart has already proved that, right? Regardless, it makes sense. Consumer staples, yes, as people cut back, they can't cut back on things like toothpaste, shampoo, go to the grocery store, buy the necessity, right? So if you want to do quick math, over this time frame to the bottom of the market, the consumer discretionary and the S&P 500 decline roughly the same, over 40%, right? It makes sense, total sense. And then the consumer staples down roughly half of that, okay? Which also makes sense. Now, of course, timing is not easy. No one claimed to be able to time the bottom perfectly. But if you start to focus when the Fed start to cut rate because economic data deteriorating fast, the right thing to do is rotate out of consumer staples and dollar cost average in consumer discretionary, because the return of the consumer discretionary at the bottom is significantly better. In fact, it outpaced. If you look at the XLY versus the XLP at the bottom of the market, the return literally double. Yes, it's not easy. I'm not saying it's easy to pick the bottom. That's why I said you scale out and scale in. Likely you'll lose money on both. That's my plan. My plan is, if I was to have exposure to both, is to scale out and scale in, so that when the bottom happens, I will enjoy twice the return in the consumer discretionaries as the consumer and the economy return once we bottom out in a recession. Hopefully that makes sense. Hopefully this video makes sense as far as outlining the best potential strategies on where to put your money. Now, if you want to hold on to consumer staples through the thick and thin, that's not a bad idea either. But no doubt, better money can be made in rotating into consumer discretionary, right? Because if you look at the chart, if you avoid the S&P 500 and kept your money in consumer staples, guess what? You still came out ahead. So it's not a bad idea either to just stay in consumer staples. But at this point, okay, at this point, the return of the S&P at the bottom, okay, if you just eyeball the chart at the bottom of the market, the S&P 500 return matches the return on, because you see the line, they move pretty much in sync. Only the discretionary move significantly different and higher, right? So you're not getting a better return. See, the bottom line is the consumer staples, you lose less on the way down, but on the way up, you're not making more. Does that make sense? So you're not getting alpha on your return by keeping your money in staples at the bottom of the market. At the bottom of the market, you're better off rotating it into XLK, XLY. There's many other sectors. For those that are interested in seeing other comparisons, just let me know. But for now, I think it's best to do this 2 sectors at a time. Thank you for watching.